In this video, I want to talk to you about order block theory. It's not something that I use a lot in my trading. It is useful, it does work, but you really need to know your directional bias. So we're going to look at this in hindsight on the Euro 15-minute chart. Clearly, we are moving up. I want to show you how you can kind of follow the move. It's called order flow. How you can determine order flow. Where are the institutions buying this market for this bullish move up? And where can you also get in and ride the wave, okay? You do have to have narrative. You do need to know the directional bias, but you can easily kind of work out what's going on by the time you, let's say, perhaps get to London, or by the time you, let's say, perhaps get to New York, because you'll be able to connect the dots and see where order flow is heading. So I want to first highlight what an order block is, okay? It is a down candle, right? That's an order block right there. It's a down candle that takes out some kind of low on the left, okay? And it has to be inside of a session. So this particular one is in the Asia session. We're talking about this down candle, okay? Only the down candle, not the green candle. So it's just this candle here, this down candle. And look at that down candle. It's come down and it's basically stopped everybody out, right? Everybody's been stopped out there. So that's a valid down candle to consider. Now it has to be inside of a session. So this one in particular is the one that, what time is that? That is at 10:15. So Asia is between 8 p.m. and 11 p.m. Okay. Now what makes these more important is when they appear at the new hour, or at 15 minutes past the hour, or at the halfway mark of the hour, like 10:30. Okay. So it's at the hour, for example, 10 a.m. in the Asia session, or it could even be, sorry, it's 10 p.m. It could be 9 p.m. It could be 8 p.m. Right. It's better if it's in the second hour or the last hour. Okay, so this one is in the last hour because 10 o'clock to 11 o'clock is the last hour of the Asian session. And then at the hour is very good. 15 minutes is okay. At the halfway mark, like at 10:30 will be okay. And obviously at the start of the hour at 10 a.m. You can't, the one that forms at the end of the session, like if this was 11 p.m, may not be that important. So you got to have it down candle at the right time, and it has to take out liquidity on the left. Okay. What you then do is you need to have, so that's one part of the rule, then the market needs to trade above the high of that candle, right? Those things make this a valid order block. Everything I've said there, after the high of that has been traded, and I like to see a green candle close above the high, okay? So notice all the things I'm saying here, because all those things are important, okay? And that's how I use them. So you need to follow the rules if you want to trade these, how I use them. And I said I don't use them that often. Now let's repeat. You have a down candle within a session, right? In this one, it's Asia session. That down candle has to have taken out some low. It doesn't have to be every single low on the left, some low, okay? And that particular down candle, we're looking at a 50-minute chart, right? It can be any time frame. That down candle needs to be at a key time, at the new hour, preferably the second hour of the session, in a 3-hour session, at 15 minutes past the hour or 30 minutes past the hour, okay? I wouldn't consider something at, for example, 45 minutes past the hour. That to me is not good enough, okay? So then that's part one. Part two is that the high has to be traded above, and I like to see a candle close above. So this green candle, this bullish candle, has closed above the high of that down candle. That to me is a valid order block given all those rules. Okay, we then draw a line on the high of that down candle. So I am going to draw a line across there. Okay, and what we then want to see is that candle traded back into, right? It can trade to the wick, which is the high, to the open, or in the body. Okay, you don't want to see the halfway mark of that traded down into. It can, but I don't like to see that. And the candle that trades into there must be in the next session, right? So here is London, right? London has now traded into that, okay, that down candle, which was the previous order block. Now, I don't like, as I said, when it's 45 minutes past, but you can see the next candle is at the new hour. So all of those three candles are consecutive, and I will consider all of those sufficient to come in to this order block. And now what happens? The candle, or all three of those, become the new order block. Once again, same rules. So let me repeat. We've got these three candles. I'll just consider that as one big candle, has traded into the candle that we have identified as the order block. Okay, and that down candle has taken out some lows on the left. Okay, that's important. And I take all of those, and that is now the next order block. What's important is that I don't want to see the down move, right? I don't want to see the down move go more than 50% of this candle's range between the high and the low. So if I mark out using a fib tool, high, low, there's a 50%, okay? It hasn't come down to 50%. Then that's good. I like that. I don't want to see it go through. It can. I'm not saying that it will be invalid. It can, but it's better if it doesn't even get to the 50% of that candle's range, which we are identifying as the order block, okay? And if you do get in, let's say at this point, your stop is under that order block, Okay, I typically like 15 to 25 pip stops anyway. Okay, so I'm going to take this off. So now these 3 down candles are our new order block because this has now taken liquidity. It's at 3 a.m. So I'll take all of them and it's come into our original order block from Asia. So I'm going to now do the same thing. I'm going to mark the high of the highest of those 3 and I'm going to make a line there. And you can see now we again are trading into there, right? That's at, what time is that? That candle there is 3:45, okay? And then we have another one that's trading into this one, right, at 4:15, which I'm happy with. So this particular down candle has connected with this order block, and then the one at 4:15, which is one of the times I've said is valid, is trading into that down candle. So they are connected. So I will accept that. I will accept that, right? That there is 3:45. I don't like that time. But the fact that you've got another one straight after it coming down into this one, which is connected to this one, and that is at one of the key times I've said, like 15 minutes past the hour. So I will accept that as the order block, okay? They're basically connected with this one, okay? So we can connect this high now, like this, okay, to that one. And now that is a valid order block, as I've explained, because it's trading down into this one, which is at 3:45, which I don't like. But the fact that this one, which is at 4:15, is trading into that, and that one is traded into this one, that is acceptable. So that's my order block there, okay? And the high of that and the open of this is the same. Now, all I want to see is I'm going to make a line to this one, and that's our order block. And now we have 6:30, which is just prior to the the New York session. New York starts at 7 a.m. Come into that particular order block, okay? Now, I do prefer it to be in a session, but sometimes the market is not going to give you everything on a silver platter, right? But the fact that that's come in, it's at halfway into the hour, connecting to this order block, so that's the entire order flow we're connecting now. I'm happy to accept that as a order block. And then we have a move up. So order flow is to the bullish side, okay? So ideally that would have been nice to have seen that come in, connecting to this order block at 7 a.m. inside of where the New York market opens. But the fact that it's at 6:30, halfway into the new hour, okay, just half an hour prior to the New York session is okay. And so you can see each one of these down candles, so this is Asia, when London trades into it at the right time, then that is where the institutions are buying. Okay, remember, each one of these down candles needs to have taken liquidity and traded above, and you're waiting for the market to come back down, right? This London session is an entry where the institutions would have gone long, okay? The market moves up. Notice this down candle takes out the low of the previous down candle, so it's taken out liquidity, okay? And this one, the reason I don't like this is because at 3:45. It's valid, but I just don't prefer them at that time. The next one trades right into that one after a move up, okay? And therefore, I'm just connecting those because that one's connected already, and this is at the right time. Okay, so to me, that is basically the one order block, right? I'm just ignoring the green candle. Ignore the green candle in there and just assume that that red bar and that red bar is one candle. And I'm taking a high of that, pushing it out. And that now, look at this down candle. These 2 down candles take out liquidity. On the left, they take out these lows. Okay, they push down. These lows are taken into this order block. Also this one, right? It's 1 bar. Okay, so if I was to take the range, I'll take the low of that and the high of that and say that's my range. And I want to not see, let's just put a fib on there, low of that, high of that. You can see again, it doesn't come into the 50%. As it's moving down, it's taking out liquidity. Again, that's where institutions are getting in just prior to the open of New York. Okay, so that's how I use those down candles with the narrative that we're in a bullish market, or on this day we're bullish. Even if we didn't know we're bullish, we can see that Asia's taking out the lows, we're moving up. London's taking out these lows, we're moving up. It's kind of stair-stepping up. And then New York is again moving up. So it's basically higher lows, higher highs. And in New York, we're still moving up, okay? And so let's say New York's, depending on the time, let's say, what time is it in New York? It's 8:30. So if 9 o'clock we come down, let's actually draw a line here. 9 o'clock we come down to the high of there. Let's also put a fib on there. The high, the low, okay, there's my 50%. If 9 o'clock, which is a new hour, in half an hour's time, or at 9:30, I want to see the market come down and into this level, and that will be where the institutions are going long. What's important also is you need to know where is your target, right? So if you're very close to your target, and this is now too close to the high, which is your target, then this will not be valid. You've got to know where you're going, where you're heading, okay? So let's assume we are heading up to 108.50. So I'm going to draw a line, a vertical line at 108.50. Let's just assume that's our target. Okay, you got to know where you're going, you got to know the direction, and you got to know where your key higher levels are that you're targeting. Okay, so if I say that's my target, I don't know where that's gone. Let me try and find that line. So it's actually right up here, 108.50. Okay, what I would do is I would take the lows. Okay, where's that level? 108.50. So let's just come down here. Okay, I would take the low there, and measure the high. Okay, and so these order blocks are valid so long as we are underneath 50% of the range of where we think this market is headed. Okay, so if we do get a move down based on that target of 10850, if we do get a move down into this order block that I've drawn, okay, that is valid. It's a valid order block and it's not too close to our target. We are underneath 50% of the range of where we expect this market to go. Therefore, if I do get a move down at 9 o'clock or 9:30 or 10 a.m., then I would be in line and expect institutions to also go long from that level. Okay, hope the video makes sense. You need to go and rewind it. And what's more important than just going back and watching it again is go back and do this on your own chart so you understand what I'm saying. You might have to pause and rewind to understand the rules that I've mentioned, but they are the rules that I use when I'm using these, and that is how I connect these order blocks together to follow order flow from the higher time frame institutional traders. Okay, so right now I'd be waiting for a move back down to 1.07850 right here, okay, and just watch the market and see we get down at the right time, 9 o'clock or 9:30 or 10 a.m. Okay, it's got to be one of those times. I won't do it after that, and then I want to see the market kind of respecting that level, and that will be where the institutions, I'll be expecting the institutions to get into that level. Notice also that we have what's known as that fair value gap right there. So not only is the market coming down to take liquidity on the way down by way of these stops here, it's also coming down to get more orders and to rebalance this particular gap that is left open on the way up. Okay, so I hope that the video is useful. As I said, you've got to go back and study the charts and practice this so that you know what you're looking for. Don't forget the order blocks need to take liquidity on the way down. Okay, and I've added a time element to make sure you identify the right order blocks based on the times that I've mentioned. Okay, and each order block needs to be traded up through with a closing candle above the high of that down candle for it to be valid after it has taken liquidity. Okay, so all of those things are important, and you want to put your line where you basically the high of that order block to the 50% of that range is going to be where you want to see the market come back down into to collect more orders. Okay, so I hope it was useful. I'll talk with you in a future video.